Good morning, everybody. This is the live market open for May 31st. May is about to end. I'm Yohay, Elam, Forex Crunch and Market Movers podcasting the show as usual for FX Trade. As usual, we'll cover recent developments in markets, discuss the various charts and levels, preview the upcoming events with a special focus on the non-farm payrolls. Our currency of the week is the British pound, pound dollar, as we're seeing lots of turbulence. And of course, we'll preview the week ahead and wrap up the show. As always, your questions are more than welcome. Good morning, Jax. Good morning, Margus. Good morning, everybody else here. If you cannot see the chat box alongside the screen, please go to this address, tlk.io/fxrate-forex-live-video. Okay, so the big news from this morning is that one UK poll shows a hung parliament and the pound is falling. So we have the YouGov poll published, I think, in the Sunday Times. Anyway, it's only one poll, but it shows that the Tories, the May's party, falls short of an absolute majority, something that was totally unexpected. The whole debate was about what kind of majority will she get. She wanted to get a personal mandate. And this, of course, weakens the pound that does not want to see a hung parliament and does not want to see Jeremy Corbyn as prime minister. If we have coalition negotiations, we will not have orderly Brexit negotiations. So that's the big news from this morning. I must say that other polls, including the Guardian's ICM, show different kind of leads for the Tories, providing an absolute majority. So it can be sometimes 12% in the ICM example, and others show 7-8%. So we'll have to wait for more polls to confirm, but the trend is clear that Theresa May's Conservatives are not as strong as people thought they would be. Let's continue with other news of the day. Still a lot of uncertainty about the Fed hike. It's truly data dependent. Doubts came through via the core PC price index, which dropped 1.5%. That's the Fed's favorite inflation measure. But on the other hand, Fed officials are sort of looking forward to raising rates. The big test is, of course, the non-farm payrolls. We'll preview that later on. Draghi, he spoke late last week and also this Monday. He keeps the pressure on the euro, so the message is we are happy with the growth, less downside risks, but inflation will have to keep pushing. And as we've seen, inflation figures, at least earlier this week, published yesterday and also this morning from France, are showing a slowdown in inflation in the month of May. We'll have the all-European flash figures just in a couple of hours. Okay, and oil prices are finally stabilizing, not going too far to the upside nor to the downside. So, well, a little bit of boredom over there as we have excitement elsewhere. A few pieces of data on Friday, just before the long weekend in the US and in the UK. GDP was upgraded to 1.2% annualized, still lower than the 2% annualized in the Eurozone, but a bit better than expected. On the other hand, if we look at data for Q2, durable goods orders for the month of April fell short, disappointed with a drop of 0.4%. All right, trying to eliminate some noise here. And as I mentioned before, core PC price index slowed to 1.5. Yesterday's consumer confidence figure missed, but only marginally. It still remains relatively high. Okay, outside the United States, well, let's talk about the Fed a bit more. The Fed minutes published a week ago after the show, they showed a tightening coming relatively soon. Okay, on the other hand, more evidence is needed, so they gave a message for everybody. Bullard is worried about inflation. On the other hand, Williams is relatively hawkish. Brainerd seemed hesitant about rates due to low inflation, but not 100% certain. So she might want to delay, if I understand what she's saying between the lines, she might want to delay the next rate hikes, but on June, she needs some clear evidence not to raise rates. That might come from the non-farm payrolls, but so far she didn't get it. Outside the United States of America, UK GDP was downgraded to 0.2. French GDP upgraded to 0.4, so a bit of GDP changes. German, Spanish CPIs look weak. They were released yesterday. Today's French one looked weak. Remember that expectations for Eurozone CPI this morning are expected to show well. Expectations are lower than they were for the month of April. But in any case, we don't want them, well, if you are a Euro bull, you don't want them to go too low. We'll have to see what happens there. The Bank of Canada, for those trading the Canadian dollar, they were relatively optimistic, seeing the glass half full and looking to the bright side, strong growth rather than weak inflation. OPEC, we had there a buy the rumor, sell the fact that was already last Thursday. Since then, we had oil prices rising once again. Basically, OPEC extended the deal from for another 9 months. So production will be cut until through March 2018. Okay, and yeah, but there were exemptions for Nigeria and Libya, and this could mean higher supply than they expect. And well, on the other hand, U.S. shale production, it's still growing, but it's not growing that fast. All in all, we had a rise to $52, a crash to 48, and now oil prices are stable once again. So we had a lot of action last week, but now things are a bit more stable. Okay, so we finished our sort of news of the day. Now let's go on to the charts. So this is our technical segments for major pairs for June. June begins tomorrow. So we'll begin here with euro dollar. Euro dollar currently at 111.90. Let's look at the bigger picture. All in all, the pair is stable. The trend remains to the upside if we look at the daily chart. Resistance there at 112.66. High resistance 113. Even higher 113.60, 114.20. Support 111.60, 111.20. And lower we have 110.50, 109.50, and 108.20. Okay, so euro dollar made a move to the upside and now is trading in range, consolidating ahead of the next move, up or down, we do not know. Pound dollar, here we had quite a fall, mostly, well, the falls began beforehand, but you can also see the most latest one due to this YouGov poll. So we have their strong support at 127.70, further support only at 127. We're still in the higher range, the initial post-Brexit range or the post-elections announcement range. But if we fall lower, we find support 125.60 and 124.15. To the upside, we have 129, 129.80 and 130.50. And we'll have a special segment on pound dollar later on. Dollar yen, well, it dropped a bit in range, so somewhat weaker dollar. Currently at 110.90, support there clearly at 110. We didn't really fall to 110 in the last slide, but it's still a round number and the level to watch. Just below we have 109.50 and the cycle low is 108.10. Okay, to the upside we have still 111.60, as it used to be a very strong line of support. Now it's sort of a pivotal line in the range. 112.20. Further up we have 113, 113.60 and 114.33, which is the cycle high. Dollar CAD currently 134.42. The bigger picture is still an uptrend in dollar CAD. That means a weaker Canadian dollar, but in the past few weeks the pair is trending lower, thanks to the Bank of Canada, thanks to expectations for OPEC. In any case, currently we're at 134.42, support there at 133.80, very strong support. Further support 132.65 and 131.80. Resistance 135.40, 136, 136.40, and high above the cycle high of 137.90. Aussie dollar, very much in range, not going anywhere fast. We're off the lows there, but can't say we're really moving up. The wider trend is to the downside. So currently at 74.54 resistance, I would say weak resistance 74.90, stronger resistance at 75.20, 75.66, and very strong resistance, a cap of importance there at 76.10. To the downside, 73.75 and 73.25. Okay. Kiwi dollar made quite a remarkable comeback, the highest now in the past 3 months. Currently at 71.10, just above support there at 70.90. Support also at 70.40 and 69.67. The low point for this cycle was 68.15. Resistance 71.25 and 72.50. And dollar Swiss, prone to intervention as always, at lower ground, reflecting a weaker dollar and some demand for the safe haven Swiss franc, but well, and not enough intervention perhaps. Low support there at 97, resistance 98.20, 98.60, 99, 99.60, and parity. Yeah, so this concludes our major pairs for, well, as the month of June is about to begin. Let's continue with crosses. So we'll begin from your Swiss. Talk about it briefly. Not a very interesting cross. 109.10, resistance there at 110, of course, the very round number. Support 108.70, 108.50, and 107.80. This is where the S&B intervenes. Beware. Euro pound. The Brexit pair is on the move to the upside. Strong euro after the French elections and recently worries about the British elections. Lots of politics involved here. 87.30 is the current level of resistance. 87.80 further resistance at 88.50. In any case, we're currently trading sort of around the monthly highs. Support at 86.75, 85.80, and low support there at 83.80. Euro yen, a popular cross, at least for banks, maybe not for traders. Currently 124.20. Resistance 124.53, 125 round number, and 125.80. Support at 123.80 and 123. The Dragon Gepi pound yen currently 142.20. Support 140.50, 138.60, and low support 135.50. Resistance 146.80 and 148. And as always, we conclude our segment for crosses with a quick look at crude oil, looking at WTI crude oil. As you can see, we had quite a bit of volatility there, but once again, some stability. 49.20 is the current level. Support 47. Used to be a triple bottom. Low support 43.70. 50 around number isn't that strong. 52 is already, well, a strong cap. We've seen the turnaround over there. 54.50 and 55.20 are the lines to watch on the top side. Okay, so this concludes our technical segment for crosses. And now let's preview. Let's talk about the upcoming events. So just after the show today, we have at 9 a.m. GMT, the Eurozone inflation figures. They're expected to show a slowdown in inflation. Core inflation reached the highest level since 2013, back in April at 1.2%. Now a drop to 1% is expected. If we'll have a drop below 1%, we can easily expect downward pressure on the euro. Canadian GDP, for those trading the loonie, we have monthly GDP numbers at 12:30 GMT, and not so important, US figure, US pending home sales. I'm mentioning that because that's also the time of around the London fix. Okay, the last hour of trading in London for the month, and we can see some last-minute reactions there, some last-minute action. Okay, tomorrow, a new month, June 1st. Almost summer. Lots of figures to begin the month. Double feature in Australia, the capital expenditure report and retail sales at 1:30 GMT. 15 minutes later, we have the Chinese Caixin PMI, also important for Australia and for the whole world. There are worries about Chinese slowdown. Moody's downgraded China because of worries about private debt. We have to see if manufacturing goes well. Of course, stronger manufacturing in China means more consumption of iron ore and copper from Australia, but it also has an impact on the whole world. Remember that China is the world's #2 economy. Manufacturing PMI in the UK tomorrow morning, but it's 1 week before the elections. I expect all UK indicators to be a bit more muted. A big hint for the non-farm payrolls, ADP, NFP at 12:15. There's not always such a strong correlation between the ADP and the official BLS NFP, but in any case, it still moves markets. We have also jobless claims at 12:30, and the US ISM manufacturing PMI. The manufacturing sector is smaller than the services sector in the US, but we don't have the services sector PMI before the non-farm payrolls this time. That means that the manufacturing PMI released on Thursday, 1 day before the non-farm payrolls, could have a magnified impact. Okay, and Friday, UK construction PMI, but of course the main dish is US non-farm payrolls at 12:30. And we also have the Canadian and US trade balance. Non-farm payrolls, of course, is our main event, our special preview of the day. Before we move on, a comment here by Jax. ADP is just a payroll company. Yeah, they're quite a big payroll company. They have their arms spread all around the world. They have big offices here in Barcelona, where I'm sitting. And they manage payrolls for a very large chunk of the private sector in the US. So they should have an impact. In some months, they do serve as a good prediction for the NFP, but not, I think it was quite poor in March. Again, take it as a market mover on its own, but not necessarily a prediction for the NFP, okay? Okay, and now, of course, the NFP, the non-farm payrolls. I would easily say it's all about the money. There's a 90s song, early 2000 song, goes something like that, all about the money. Wages are important, more important than payrolls by far this time. You can say it with confidence. So this NFP is critical. Why? Because there's high uncertainty about the June decision. The Fed makes its decision in exactly 2 more weeks. The Fed is data dependent. It has 2 mandates, jobs and inflation. Wage growth sanitizes both. That means that if we have strong, if the US economy is at full employment, that means that that job gains should slow down because employers find less people to hire. But because there's a higher competition for employees, they raise their wages. When wages rise, people consume more, and they don't consume only more food or more energy, the more volatile items that the Fed does not care about, but they consume more big ticket items. And this pushes core inflation higher. So more furniture for the house, more cars, televisions, you name it. And this should push prices higher, and then the Fed should raise rates. So that's the key. That's why wages are now important, because we're at a point in the cycle where the Fed wants to tighten as we're nearing full employment, and the best reflection of full employment is rising prices. So high job gains plus no wage gains, still a lot of room to go. That's what we had last time. So we're not at full employment because we had so many jobs gained and wages got stuck. The economy is far from overheating. So steady, slow, frustrating growth, you name it, but not overheating, that's for sure. Last time on the Non-Farm Payrolls show, the king of Forex indicators, 211,000 jobs were gained. The unemployment rate dropped to 4.4%, which was a point of envy maybe for many countries, but the participation rate is lower. So if you're counting less people as the workforce, and out of this smaller group, the unemployment rate is falling, less people are out of work, it's not such a good, not convincing enough, let's put it this way. Wages did disappoint last time with 2.5%. Year over year, a setback. It's not too bad, but it's the average. It's not overheating. It's not getting closer to 3%. Each time we take a step forward, we take a step backward. This time, we're expecting more or less in terms of jobs gained, 186,000. Wages are expected to rise 0.2 month over month after 0.3 last time. That's the month over month, not the year over year. Jobs expectations are going to be shaped, of course, by the ADP, but not wages. ADP does not give us wage information. Remember, as always with the non-farm payrolls, the initial reaction to the news is not necessarily the correct one, especially if, as we've seen last time, the first reaction was to the headline, jobs gained, and not to the wages. So how do we trade it? First of all, with low leverage, because it's a very volatile event, and take care out there. My prediction is, if wages are 2.5% year over year or lower, that could be an ominous sign for the Fed regarding the June decision, and the US dollar could fall. If they're at 2.8%, the cycle high, or even higher, then I think it provides a smoking gun for the Fed to shoot to raise rates in June, would alleviate concern, and the US dollar could move to the upside. In between, which doesn't leave too much space, 2.6, 2.7, I think it leaves a lot of room for speculation, for choppiness. In any case, as aforementioned, ignore the initial move that could be only related to the headline jobs and focus on wages. Okay. Any questions before we move to our next segment? Is the pound. No, not yet. Okay. So, currency of the week, pound dollar. It's all about the elections. If for the non-farm payrolls, it's all about the wages. Here, it's all about the elections. 8 days to go. Every opinion poll matters. The opinion polls have more impact than any economic figures. I prepared this slide yesterday, and since then, indeed, we had this YouGov poll published on the Sunday Times. So any economic data, PMIs, which are of importance to the US economy, they will probably have some kind of an impact, but a very short-lived one. So here we have the two contenders, Prime Minister Theresa May and Labour leader Jeremy Corbyn. All in all, markets want a Tory landslide. Why? Markets in general prefer right-wing governments. They're seen as more pro-market, okay? It doesn't work in all cases. Markets did want initially Clinton to win, but in this case, conservatives are seen as pro-market. There are hopes that with the big mandate, if Theresa May, Prime Minister May, wins a big majority in Parliament, she'll have less problems, especially from her own party, especially from those saboteurs of Brexit, and she could make a U-turn. She could make a U-turn to a soft Brexit. Okay, she made a U-turn on other issues. She could do that here as well. A narrow majority means more pressure from those Brexiteers, such as Boris Johnson and his friends. Labour, on the other hand, does not offer a better Brexit. Jeremy Corbyn is not Tony Blair. Jeremy Corbyn is not Gordon Brown. And the stance on Brexit is not very different. Okay, the only party that really has a different approach to Brexit is the Liberal Democrats, but they're a small party and they're not expected to have an impact. Maybe they'll gain some seats, but not too much. Okay, so polls show Con. You may see it many times. Con is short for Conservatives, also called the Tories, leading Labour, LAB, by 6 to 12%, which is quite a big margin, of course. So polls are all over the place. 6% means an absolute majority, but a narrow one. Okay, so more of the same currently. The Conservatives have a small majority in Parliament. 6%, 12% means a big landslide, again, of, 90 seats, which could let May do whatever she wants. 3% more or less means a hunk Parliament. What I put here is this YouGov poll that shows the Tories falling short of an absolute majority, so only 310 seats, short of 326. And Labour, on the other hand, also not winning, staying behind. That means that there will have to be some kind of a coalition, a hung parliament, and a long period of negotiations. And uncertainty is the worst thing that can happen for the pound. Okay, regarding the elections, we'll do a preview also next week, but do a quicker preview this time. The expectations will be shaped up by the final polls. If we have a landslide majority for the Conservatives, pound should rise. It'll be a sigh of relief. We'll have 5 years with less political drama in the UK. Remember, we had elections. We had the Brexit vote last year. 2 years ago, we had elections like these ones in the UK. 3 years ago, we had the Scottish referendum. Markets are a bit tired of that. If we have a narrow majority, pound is stuck, a bit uncertain, maybe even falls. Basically, at least it's more of the same. I would expect it. No big movements. And if we have a hung parliament like this YouGov poll suggests, then we might see a strong negative reaction, maybe exaggerated by writing here Brexit 2.0. Won't be such a big fall of 1,500 pounds, but it's not what markets want to see. Let's put it this way. Schedule for next week. We'll do this again, a specific preview of the elections next week, but in general, exit polls are expected at 9 GMT. That's 10 p.m. in the UK. Okay, on Thursday evening, June 8th. They're coming out on very thin trading conditions when only Australia and New Zealand are half awake. At 11 GMT, we'll have initial real results coming from, well, in the Brexit vote, it was Sunderland, if I'm not mistaken. Anyway, that'll be just the initial drip. More results will come in around midnight GMT, and that's when the volume also rises because Tokyo comes into play by around 6 GMT. So we'll have results coming out throughout the night. Counting is very slow in the UK. Don't know why this happens in France and Spain. It's much quicker. By 6 in the morning, we'll have full results. And from 7 a.m. GMT on Friday morning, we'll have the full market reaction at the European Open. We'll probably have some statements by the various party leaders. Okay, so that's the schedule. Watch every poll between now and June 8th. I'm not sure about the electoral law in the UK. Polls are forbidden on election day, but I'm not sure if they're allowed on Wednesday, on the day before the elections. Anyway, it's going to be quite exciting. The race has become much closer, meaning much more volatility. I'm all in on volatility. Okay. So that's the pound or currency of the week, and which, well, focused a lot on elections. And let's preview next week, which of course includes the UK elections, but also some other things, naturally. So Monday, in some European countries, it's a holiday, like here in Spain. But the UK and US markets are open, so it'll be quite fast, and so trading volume should be quite okay. We have the UK services PMI, maybe the last important data point before the elections, the last opportunity to move the pound, except from opinion polls, which are published at various hours. The ISM non-manufacturing PMI, it doesn't serve as a hint for the non-farm payrolls, but it's still important. On Tuesday, we have an Australian rate decision. No change is expected. Okay, the Reserve Bank of Australia is expected to leave rates unchanged at 1.5%. They don't intend to rock the boat. We also have the US jobs report, another hint for the June decision. The Fed likes to look at it, but remember it's a lagging figure. It relates to the month of April, and the non-farm payrolls is for the month of May. On Wednesday next week, Australian GDP released only once per quarter, no revisions, giving it more importance. We have oil inventories, as always, every Wednesday, and final Japanese GDP. And everything happens on Thursday. We have the ECB rate decision. So maybe we'll pause a bit more on that. The European Central Bank has its more important decision. We'll preview that next week, of course, more in detail. But in general, they publish new forecasts. They publish, they have 8 decisions every year. 4 of them include new forecasts and are more important ones. This one is the more important one. The expectation is that they'll begin hinting about the beginning of the end of tapering. It sounds quite a mouthful, but I'm saying this because the QE program runs until the end of 2017, the end of this year, and they will probably begin squeezing, shrinking, reducing the number of bonds that they buy from 2018. We won't get full details. We'll just get a hint that downside risks maybe are gone. They have diminished, we've learned in the past meetings, but maybe now they're gone. They'll move to a more neutral bias, and that, well, it'll be helpful for the euro. It will not be such a huge surprise. It depends on the inflation figures today. Okay, so the Draghi show, as usual, join live coverage. It should be fun as well. And, well, US jobless claims, just as a filler, I would say, the talk next Thursday all day is going to be about the UK elections, but it'll be empty talk during most of the day. Well, maybe not so much empty talk. Another point to note, again, I talked about turnout. If we have reports about a high turnout, it's good for labor. That means bad for the pound. If we have low turnout, it means it's better for Theresa May's Conservatives. Okay, and Friday, that'll be the big day of the reaction to the UK elections. And we also have industrial output in the UK. Will probably be totally ignored because of the elections and the Canadian jobs report. And this will have an impact on the Canadian dollar, of course. Okay, so next week it begins a bit slowly, but then Thursday and Friday, it's going to be an explosion. Okay. Any questions? Nope. Okay, so let's wrap up the show for today. This is the wrap up for the live market open for May 31st. We're closing the month of June with the pound falling on UK polls showing a hung parliament, a YouGov poll. Remember, other polls show different stuff, but pound is falling. We'll show the charts very soon. High uncertainty about the Fed rate hike. It's truly data dependent. It all depends on the non-farm payrolls. Non-farm payrolls are expected to show another normal gain of jobs. Watch out for wages. They're far more important. Draghi keeps the pressure on the euro, but everything depends, I think, on inflation figures today. And oil prices are stabilizing. Data was quite mixed in the US. So some figures are better than expected, some worse. I think it leaves the stage open for the non-farm payrolls. The same goes for the Fed members that were talking. Some were more optimistic, some were worried about inflation. Brainard, a known dove, she stuck to the middle ground. She did express worries about inflation, but as far as I understood, it implies maybe slowing down future rate hikes, not the June one. Elsewhere, well, UK GDP was downgraded. Bank of Canada kept the loony bid, and we had French, German, and Spanish CPIs. They looked weak, so that's a preview for today's inflation figures. Really important ones for the euro. Last time we had strong ones. Core CPI, the highest since 2013. This time it could fall. Watch out for Canadian GDP if you're trading the loony. Tomorrow, a busy day. ADP, NFP, which Jack said is only a non-payrolls company, but they do have an impact. Also, the ISM manufacturing PMI serves as a hint for the NFP. And on Friday, of course, non-farm payrolls. If the Fed is truly data dependent, this is the data point that matters. I would say, in this wrap-up, to conclude, if wages are stuck at 2.5% or lower, it's an ominous sign for the Fed, and the dollar could fall. 2.8 or higher, the USD could surge. In between, lots of speculation and choppiness. Trade carefully out there. The initial reaction might not be the correct one. Okay, let's look at the charts. This wrap up. So euro dollar at the moment very much in range, hardly moving on the day. Another day of frustration in euro dollar, but all in all, the trend remains the upside. Support 111.60, 111.20, resistance 112.66, 113. pound dollar, well, as we speak during the show, it's recovering from the lows, but still down on the day. Support 127.75. Currently, yeah, well, weak resistance there, I would say, at 128.25. Stronger resistance 129 and 130.50. Dollar yen slipping, well, not going too far, 110.80. 110 is support, resistance 111.60. Dollar CAD, steady she goes, 134.40. Support 133.80, resistance 135.40. Aussie at 74.75, resistance at 74.90, 75.20, support 74.50 and 73.75. Okay, so that was our quick wrap up. Pushed in a lot of stuff in a short period of time. If anybody, such as Jax or Margus or whoever, if you have a question, I'll give you a few more seconds. In the meantime, it's important to note that after stock markets fell, I didn't say the word Donald Trump, the name Donald Trump, even once today. So that provides some support for the US dollar. But he's back to Washington. He could be back to tweeting while he remains quiet. US stock market advances. Jack says, thanks, Yohay. I love your insight. Thank you very much for the kind words, Jax. Okay, so I guess that's it for today. As usual, thank you very much, everybody, for coming. Wish everybody a safe and successful day in markets. It should be lots of fun. Anything coming out from the UK, I put all my alerts on. And, well, also the euro is becoming more interesting. And, well, euro, pound, yen, major currencies are back. Jax usually asks, which currencies should we look out for? So today I would say it's euro dollar. And that's it, I guess. So see you next week. We join our live coverage. I believe it's the ECB, the next one. And that's it. So thank you and bye-bye.